During the quarter, the Merchant West SCI Global Managed Growth Fund returned minus 3.1%, performing in line with the peer group average. Global markets were volatile despite growing optimism that we are near the top of the interest rate hiking cycle. While inflation remains above most central bank targets, it is now trending in the right direction, and there is mounting evidence that higher interest rates are finally having a negative impact on economic growth in the United States. Heightened geopolitical tension in the Middle East and China's property market woes are also likely to contribute to a slowdown in global economic activity and prompt central bank policymakers to start cutting interest rates well before inflation is within targeted ranges. The uncertain outlook for interest rates and comments from several central bank officials that interest rates would need to stay higher for longer pushed US Treasury yields to multi-decade highs. The 2-year Treasury yield finishing the quarter above 5%, while the 10-year Treasury yield rose 75 basis points to 4.6%. Against a backdrop of rising global bond yields and increased geopolitical risks, global equity markets finished the quarter lower. Chinese stocks were once again the noticeable underperformers as the Hang Seng Index tumbled 5.9% in the third quarter. The tech-heavy Nasdaq index was also down sharply. The FTSE 100 index in the UK was up 1%, one of the very few global equity markets to register a positive return during the quarter. Total Energies, AbbVie and ExxonMobil were the fund's top performers during the quarter. The biggest detractors from performance during the quarter were Healthcare Realty, American Tower and Spirit Realty, all of which are US-based REITs. The fund's bond positions have been increased further to approximately 12.5%, following the continued sharp spike in bond yields across most developed markets. The fund's current allocations to growth assets dropped from 87% to 85% on the back of weaker equity and listed property markets, but remains in line with the fund's longer-term strategic allocation of 90%. The fund's current allocation to equities emphasizes quality over any other factor, and with global growth slowing and inflation remaining stubbornly high, quality is likely to outperform other styles, at least in the short to medium term. Once again, a reminder that the fund is ideally suited for investors looking to build an offshore income for their retirement and then to manage that income in retirement. The high and growing offshore income means investors do not draw excessively against their capital. In this way, the investor's capital is preserved and is only utilized in emergencies during their retirement, irrespective of how long that retirement lasts.